Welcome to this deep dive comparison between two popular ETFs, VOO and VUG. Exchange-traded funds, or ETFs for short, have transformed the investment landscape over the past few decades. They offer an easy and efficient way for investors to gain broad exposure to segments of the market, asset classes, or investment strategies. In essence, ETFs are a basket of different securities that trade like a single stock on an exchange. Today we're going to focus on two particular ETFs, VOO and VUG. Both of these are products of Vanguard, a company that's been a pioneer in the world of low-cost passive investing. Vanguard is renowned for its philosophy of long-term low-cost investing that puts the investor first, a philosophy that is clearly reflected in both VOO and VUG. VO, or the Vanguard S&P 500 ETF, aims to track the performance of the S&P 500 index, which comprises 500 of the largest U.S. companies. It's a fantastic option for investors seeking exposure to the broad U.S. stock market. On the other hand, we have VUG, the Vanguard Growth ETF. This ETF tracks the performance of the CRSP U.S. Large Cap Growth Index. It's primarily made up of large U.S. companies that are expected to grow at an above-average rate compared to other companies in the market. Both of these ETFs have their own unique features and benefits, and both could potentially play a role in your investment portfolio, depending on your individual goals and risk tolerance. But how do you decide which one is a better fit for you? Well, that's exactly what we're here to help you with. Over the course of this video, we'll delve deeper into what each of these ETFs entails. We'll compare their performance, discuss their management fees, and help you determine which one might be the better choice for your specific investment needs. Now that we know what VOO and VUG are, let's move on to understanding their differences. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. Let's begin with VOO. What exactly does it represent? VOO is the ticker symbol for the Vanguard S&P 500 ETF. An ETF, or exchange-traded fund, is essentially a type of investment fund and exchange-traded product traded on stock exchanges. VOO was created by Vanguard, one of the world's largest investment companies, renowned for its low-cost offerings. Now, the S&P 500 inches part of its name refers to the index that this ETF aims to track, the Standard & Poor's 500 Index. This index is widely regarded as the best single gauge of large-cap U.S. equities. It's a market capitalization-weighted index of the 500 largest U.S. publicly traded companies by market value. In simpler terms, when you invest in VOO, you're essentially buying a small piece of the 500 largest companies in the United States. This includes a diverse range of companies from various sectors: technology giants like Apple and Microsoft, healthcare leaders like Johnson & Johnson, financial behemoths like JP Morgan Chase, and consumer staples like Procter & Gamble. So, you're not just investing in a single company, but a broad slice of the U.S. economy. This broad exposure is one of the key benefits of VOO. Instead of trying to pick individual winners in the stock market, you're spreading out your investment across many of the top-performing companies. This diversification can help reduce the risk associated with investing. The goal of VOO is not to beat the market, but to match it. It's a passive investment strategy aiming to replicate the performance of the S&P 500 index. And it has done a pretty good job at that. Since its inception in September 2010, VOO has closely mirrored the return of the S&P 500. Another highlight of VOO is its low expense ratio. Vanguard is known for its cost efficiency, and VOO is no exception. This makes it an attractive choice for investors who want to keep their investment costs low. VOO offers a broad exposure to large-cap U.S. stocks. Now let's take a look at VUG. Now, on to VUG. How does it differ from VOO? While VOO and VUG are both exchange-traded funds, or ETFs, offered by Vanguard, they cater to different investment strategies. VUG, which stands for Vanguard Growth ETF, specifically targets those companies within the S&P 500 index that are projected to experience above-average growth. Think of it like this: if the S&P 500 is a bustling city, VOO is like taking a tour of the entire city, seeing all the sights, both big and small. On the other hand, VUG is like a specialized tour, focusing only on the most promising and exciting new developments. The companies that VUG targets typically exhibit certain growth characteristics. These might include high projected earnings, strong sales growth, and a propensity for reinvestment. It's these high-growth companies that VUG zeroes in on, aiming to provide investors with a slice of this potential growth. VUG's portfolio leans heavily towards the technology sector, with companies such as Apple, Microsoft, and Amazon often making up a significant portion of the fund. This sector bias is due to the fact that tech companies often exhibit the high-growth characteristics that VUG is after. But it's not just about tech. VUG also targets companies in sectors like consumer discretionary and healthcare. The common thread here is growth, regardless of the sector. It's worth noting, however, that this focus on growth can come with increased risk. High-growth companies can offer significant returns, but they can also be more volatile. It's a classic risk versus reward scenario. So let's circle back to our original question. How does VUG differ from VOO? Well, while both are part of the S&P 500, they target different types of companies within that index. VOO aims to replicate the performance of the entire S&P 500, while VUG goes after those companies that are expected to grow at an above-average rate. So while both VOO and VUG are part of the S&P 500, they target different types of companies within that index. Performance is a key factor when choosing between ETFs. So how do VOO and VUG stack up? Let's start by taking a look at VOO. The Vanguard S&P 500 ETF, or VOO, aims to track the performance of the S&P 500 index, a benchmark for large-cap U.S. stocks. Over the past 5 years, VOO has shown solid performance, closely mirroring the rise of the S&P 500. It's a steady workhorse, providing consistent returns that reflect the overall health and growth of the American economy. Now let's turn our attention to VUG. The Vanguard Growth ETF, or VUG, focuses on large-cap growth stocks in the U.S. These are companies that are expected to grow at an above-average rate compared to other market players. Over the same 5-year time period, VUG has outperformed VOO, demonstrating the potential for higher returns with growth stocks. But as we all know, past performance is not indicative of future results. So, what might have caused these differences in performance? Well, a big part of it has to do with the types of companies each ETF invests in. VOO, remember, invests in the 500 largest U.S. companies. It's a broad, diversified portfolio that includes everything from tech giants to healthcare conglomerates to consumer goods companies. This broad exposure helps to insulate VOO from sector-specific downturns, but it also means it may not fully capture the gains of a particularly hot sector. VUG, on the other hand, is all about growth. Its portfolio is filled with companies that are expected to grow their earnings at an above-average rate. These tend to be in sectors like technology and consumer discretionary, which have been some of the best-performing sectors in recent years. This focus on growth has helped VUG outperform VOO, but it also means VUG can be more volatile, as growth stocks tend to fluctuate more in price. Another factor to consider is market conditions. In a bull market, when prices are generally rising, growth stocks tend to outperform, which would favor VUG. However, in a bear market, when prices are falling, more conservative investments like those found in VOO tend to hold up better. Lastly, it's worth noting that both VOO and VUG have low expense ratios. This means more of your money stays invested and can compound over time, which is a crucial factor in long-term performance. So, in conclusion, while VUG has outperformed VOO over the past 5 years, the best choice for you will depend on your personal investment goals, risk tolerance, and market outlook. Performance can vary based on many factors, including market conditions and the types of companies in the ETF. Management fees can eat into your returns, so it's important to consider them. Now, let's delve into the world of management fees for both VOO and VUG. Management fees, sometimes referred to as expense ratios, are the costs that funds charge their investors for the service of managing the fund. These are typically expressed as a percentage of the fund's total assets. In simple terms, the more assets you have in a fund, the more you'll be paying in management fees. For the VOO, or Vanguard S&P 500 ETF, the management fee is a mere 4 basis points. That means for every $10,000 you invest, you're only paying $4 each year in management fees. Quite a bargain, isn't it? On the other hand, the VUG, or Vanguard Growth ETF, charges a slightly higher fee at 6 basis points. So, for every $10,000 invested, you're shelling out $6 annually. While this might not seem like a significant difference, these small percentages can add up over time, especially as your investments grow. Let's put this into perspective. Suppose you invest $100,000 in either of these funds and let it sit for 20 years. With the VOO, you would pay around $800 in management fees over those 20 years. In contrast, with the VUG, you would have paid out $1,200 over the same period. That's a $400 difference just from a 2 basis point difference in management fees. But don't let these numbers scare you. Both VOO and VUG offer some of the lowest management fees in the industry, making them attractive options for investors. Remember, though, it's not just about the fees. You should also consider the performance and risk associated with each fund. So, the key takeaway here is, while management fees are an important factor to consider, they should not be the sole determinant in your investment decisions. As you can see, even small differences in fees can make a big difference over time. It's all about balancing the trifecta of returns, risk, and fees to find the right investment strategy for you. So VOO or VUG, which is the better choice for you? As we delve into this question, it's essential to remember there isn't a one-size-fits-all answer. Every investor is unique, with distinct financial goals, risk tolerance, and investment horizons. The best choice between VOO and VUG will largely depend on these individual factors. Let's start by considering risk tolerance. If you're an investor who prefers a steady ship in the storm, VUO might be your go-to. This ETF tracks the S&P 500, encompassing a broad range of sectors and companies. This diversification can lead to less volatility, making it an appealing choice for those with a lower risk tolerance. On the other hand, if you're an investor who doesn't mind riding the waves for potentially higher returns, VUG could be more up your alley. As a growth ETF, VUG targets companies with above-average growth prospects, which could mean higher rewards but also higher risks. Now let's talk about investment goals. Are you investing for long-term growth, or are you more interested in steady income? If you're looking to build wealth over the long haul, VUG's focus on growth companies might align with your objectives. These companies often reinvest their earnings back into their businesses, which can result in significant price appreciation over time. Conversely, if you're more interested in steady income, VUO might be a better fit. Many of the companies in the S&P 500 are established businesses that regularly pay out dividends, providing a consistent income stream for investors. Lastly, consider your investment horizon. How long do you plan to stay invested? If you're a younger investor with a long-term perspective, you might be more inclined to take on the higher risk associated with growth stocks, making VUG a potentially attractive option. On the flip side, if you're nearing retirement and looking for more stability, VOO's diversified portfolio could offer the balance you're seeking. However, these are just general guidelines. Every investor's situation is unique, and what works for one might not work for another. It's also worth noting that these two ETFs aren't mutually exclusive. Many investors choose to hold both in their portfolios to achieve a balanced exposure to both growth and value stocks. In conclusion, whether VOO or VUG is the better choice for you depends on your risk tolerance, investment goals, and investment horizon. Both ETFs have their merits and can play a role in a diversified investment portfolio. As always, it's recommended to speak with a financial advisor before making any investment decisions. Ultimately, the best choice depends on your individual circumstances and investment goals. So there you have it, a comprehensive comparison of VOO and VUG. We've journeyed through the intricacies of these two formidable investment vehicles, dissecting their structures, performances, and management fees. Let's take a moment to recap to ensure you're armed with the knowledge you need to make informed decisions. Firstly, we delved into the world of VOO, the Vanguard S&P 500 ETF. This is a broad-based fund that mirrors the performance of the S&P 500. It's a popular choice for investors looking for a diversified exposure to the largest and most established companies in the U.S. market. Its low expense ratio is also an attractive feature, keeping more of your investment working for you. Then we explored the landscape of VUG, the Vanguard Growth ETF. This fund focuses on growth stocks within the S&P 500, companies expected to grow at an above-average rate compared to other firms in the market. For those with a higher risk tolerance and a long-term investment horizon, VUG may offer the potential for higher returns, albeit with greater volatility. We compared their performances, highlighting the fact that while both funds have demonstrated strong historical returns, VUG has outperformed VOO over the past few years. However, past performance is not a guarantee of future results, and it's crucial to consider other factors such as your risk tolerance and investment goals. When we discussed management fees, we underscored that both funds have relatively low expense ratios, with VOOs being slightly lower than VUGs. These low costs mean more of your money remains invested, which can significantly impact your returns over the long term. In essence, the choice between VOO and VUG depends on your individual circumstances, investment objectives, and risk tolerance. VOO offers broad exposure and stability, while VUG offers the potential for higher returns with increased risk. Remember, it's important to do your own research and consider your own circumstances before making any investment decisions. We hope you enjoyed this deep dive into VO and VUG. It's been a journey, hasn't it? We've taken the complexities of two major ETFs, VO and VUG, and broken them down into digestible parts. We've compared their performance, discussed their management fees, and hopefully by now you have a clearer idea of which one might be the right fit for your investment portfolio. But the truth is, our journey doesn't end here. The world of investing is vast and ever-changing. There are always new strategies to explore, new trends to keep an eye on, and new opportunities to seize. That's why it's crucial to stay informed, stay curious, and never stop learning. And that's where we come in. Our mission is to empower you with the knowledge and insights you need to navigate the financial markets with confidence. We strive to make investing understandable and accessible for everyone, regardless of their background or experience level. If you found this video helpful, we encourage you to take a moment to subscribe to our channel. We regularly post content on a range of investing topics, from ETFs and mutual funds to stocks and bonds and everything in between. By subscribing, you ensure that you never miss out on our latest insights and tips. And if you learned something new today, or if you simply enjoyed the video, why not give it a like? It's a small action, but it makes a big difference. It helps us reach more people and spread the word about the importance of financial literacy. Finally, if you know someone who might benefit from this information, don't hesitate to share the video. After all, knowledge is most valuable when it's shared, so let's continue this journey together. Let's keep learning, keep growing, and keep pushing the boundaries of what's possible in the world of investing. Thank you for watching. Don't forget to subscribe, like, and share this video. Stay tuned for more insightful content on investing and personal finance.